Hello and welcome. We've been learning a lot of terms and definitions here, and before we actually start trading, I'd like to put it all in perspective. What we'll do here is we'll take a look at two of the most popularly traded commodities, gold and oil. Let's see just how units and trading terms come together. Unlike Forex pairs and shares, which we measure in terms of their money value, commodities are measured in specific units. For example, crude oil is traded in barrels. So if we decide to trade on oil, the amount in our order box will be the number of barrels we want to buy or sell. In this example, we're buying 50 barrels of crude oil at $45 per barrel. So if we were to purchase 50 barrels of oil without any leverage, it would cost us $2,250. That's 50 times $45. However, with leverage, we don't need that amount of cash to open a large position. Our broker will lend us the money, and we just put down the required margin. Now, if leverage for crude oil is 100 to 1, that's saying that the margin requirement is 1%. We only have to put down 1% of the position size. For a position of 50 barrels of crude oil that costs $2,250, the margin requirement is $22.50, which is 1% of $2,250. As all commodities are quoted in dollars, if our trading account is in a different currency, then that $22.50 needs to be converted to our currency at the current exchange rate. And now, if the price of oil goes up or down by $1, we'll be making or losing the entire value of that change. Our broker will not be party to our wins or losses, since he's already made his profit off the spread. And remember, that's the difference between the buy and sell price at the moment we opened our position. Now, let's look at another example, this time gold. Gold is measured in troy ounces, so in our amount box, we'll be entering how many ounces we would like to buy or sell. Let's just say we'd like to short sell 10 troy ounces of gold. In our order box, we see the current market price for gold is $1,150 per ounce. Again, if we were to short sell 10 ounces of gold without leverage, the position would cost us $11,500. But since we're getting 200 to 1 leverage for gold, the margin requirement is 0.5%, and we only have to put down 0.5% on the position size. On a 10-ounce position on gold at $1,150, our margin requirement will be $57.50. The leverage will multiply our earnings by 200 if gold goes down, since we invested in a short position, but trouble's ahead if it rises. Next, we'll be learning to trade.